Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the Russian economy, and specifically what's happening with Russian housing and the Russian mortgage market. Now, this isn't actually a topic that I've ever covered before, so this is new ground. And as we've discussed many times before, it's very difficult to get tangible data out of Russia because President Putin has put a ban on the release of a lot of the information, so we can't delve down and see what's happening in many markets. But rather handily, the Bank of Russia issues a financial stability review every quarter, and in that review it covers off a variety of different areas, and one of them that they've included in the most recent review is what's happening in the housing market, and this provides us with a really interesting insight as to what's going on. Now, in order to keep the housing market buoyant, the Russian authorities have offered discounted mortgages for a variety of different purchases, and the vast majority of those discounts on the mortgages relate to new houses, and that's resulted in a boom of new houses and new house purchases. And if you follow the channel, you may be thinking that this sounds quite similar to another country that we've talked about a lot, China, as over the last 20 years or so, the Chinese economy has benefited greatly from the growth of the property sector and the property developers. However, all good things come to an end, and as I'm sure you'll be aware, companies like Evergrande and Country Garden are now struggling because they can't access the levels of debt that they once could. And it now appears that the Russian authorities have taken a similar approach with their own market. So over the last 3 years, there has been a huge increase in the amount of mortgage borrowing and the amount of property that's being sold, and therefore all of the property developers are doing very well right now in Russia. But things are now starting to overheat. Over the last 3 years, the loan-to-value ratio, so the amount of debt that people are taking on to make the purchases, and also the debt servicing costs, so the amount it costs to actually pay the mortgage, have gone up significantly in Russia. And because we've now seen a huge increase in interest rates that the Russian central bank brought in to try to tackle high levels of inflation, this is now causing major problems for people who are borrowing money to buy property that isn't under this scheme. So in today's video, we'll have a look at the details of what's been released in the Financial Stability Review by Russia, and we'll dig down and look at the latest data for loan-to-value and debt service ratios. We'll then have a look at what's been going on generally with the mortgage market, what's happening with interest rates, and then finally today I'll wrap up with my summary as to what the potential risks are for Russia over the course of the next 6 to 18 months. But before we get started on all of that, once again, I'd like to say thank you so much to everybody that supported the channel. And I know that I've said this a few times before, but I genuinely mean it. Thank you so much to everybody that's bought me a coffee, sent me a YouTube super thanks, or signed up as a Patreon or a YouTube member. Really do appreciate that. The Russian authorities offer several preferential state programs to assist consumers with purchasing houses. These include the preferential mortgage for new buildings, which is a fixed rate mortgage at 8%, the family mortgage, which is fixed at 6%, the Far Eastern mortgage for purchasers of property in the east of the country, which is set at 2%, the preferential mortgage for IT specialists, which is fixed at 5%, and mortgages for new regions, which is fixed at 2%. And this chart shows the movement in the total mortgage portfolio in Russia dating back to 2020, and this shows that the total amount borrowed by Russian consumers has increased from 7.6 trillion rubles, which is around $85 billion, to 15.7 trillion rubles, which is around $175 billion. So that means that the total amount borrowed by Russian consumers to purchase property has more than doubled over the last 3.5 years. And the rapid increase in the volume of mortgages is now causing concern in Russia as a result of high loan-to-value percentages, a high debt service to income ratio, and increasing interest rates. Now, before we go on any further today, I want to talk to you about today's sponsor, Exeter. Exeter makes the world's coolest wallets. They're super slim, around half the size of conventional wallets, but still allow you to carry up to 12 cards and cash. All Exeter wallets have built-in RFID blocking, which protects you from data theft and wireless skimming. And Exeter have also developed a super slim tracking device, which is solar powered and allows you to track your wallet's location from your phone. But the coolest thing about Exeter wallets is that they provide you with quick card access, allowing you to access your cards at the click of a button using Exeter's signature trigger mechanism. Exeter wallets come in a variety of designs and colours, and as well as making cool wallets, Exeter also make great accessories, including key cases and this uber cool tool card. And the great news is that Joe Bloggs viewers can get a discount of up to 55% by using the code JOEBLOGS at checkout. So if you're looking for an uber cool gift for someone you know, or maybe you just fancy treating yourself, please click in the link below. This chart, which is taken from the Bank of Russia's Financial Stability Review, published on the 30th of November 2023, shows the loan-to-value range for all mortgages issued in the 12 months ended September 2023. And the loan-to-value ratio basically reveals what percentage of the purchase price the borrower has taken as a mortgage. So as an example, if you bought a property valued at $100,000 and you took a mortgage of $50,000, that would equate to a loan-to-value ratio of 50% because you borrowed half of the purchase price, and by definition the other 50% would have come from your own equity. And the reason that loan-to-value ratios are important is that it shows how risky those mortgages are. If the loan-to-value ratio on your mortgage portfolio is low, so let's say it was 50% on average, and house prices fell in any particular period by 10%, your mortgage portfolio would still be considered to be low risk because even though there'd been a fall in overall prices, the amount outstanding in terms of the debt would still be considerably less than the value of the properties. So in a worst case scenario, your borrower could sell their house and repay their loan. However, if your loan to value is high, let's say it was 90%, so a borrower that bought a property for $100,000 borrowed $90,000, and then we saw a 20% fall in house prices. So that property that was valued at $100,000 was now only worth $80,000, but the outstanding mortgage was $90,000, then you as a lender would be at risk of losing money. Because if that borrower sells the property for $80,000, that isn't enough to pay off the mortgage of $90,000. So let's have a look at what's been happening with loan to value ratios in Russia over the last 12 months. The scale on the left-hand side of this chart is shown in percentages going from 0 to 60%, and across the bottom of this chart we've got different loan-to-value ratios, starting at 0 to 10% on the left-hand side and going up to 80% plus on the far right-hand side. And the four different coloured bar charts here represent the 4 quarters over the last 12 months. The blue bar chart represents all mortgages issued in the quarter ending December 2022, the red bar all mortgages issued in the first quarter of 2023, the grey bar the second quarter of 2023, and the yellow bar the third quarter of 2023, so the most recent one. And what this graph tells us is that more than 50% of all of the mortgages issued over the last 12 months have a loan-to-value ratio in excess of 80%. So borrowers in Russia are maxing out in terms of the amount of debt that they're taking on to buy property. And as we've just discussed, that's the riskiest end of the market from a lender's point of view, because when you're providing loans with a high loan-to-value ratio, if the market starts to come down, there is a risk that borrowers could move into negative equity, so basically find themselves in a situation where their loan is higher than the value of their property, and the banks therefore are at risk of losing money. And in terms of the second highest category of lending, with a loan value between 70 and 80%, around 23% of all of the mortgages issued over the last 12 months fall into this bracket. This chart plots the debt service to income ratio for all mortgages issued over the last 12 months. And the debt service to income ratio is basically looking at how much it costs to service the debt, so how much the interest and repayments are for any borrower, and compares that number as a percentage against the borrower's income. So as an example, if you took on a $100,000 mortgage and the interest and repayments on that mortgage each year equated to $10,000, and your income was $20,000, then the debt service to income ratio would be 50%, because 50% of all of your income would be going on those mortgage payments. And the reason that this ratio is important is that it tells us how risky these mortgages are. If all of your borrowers have a high debt service to income ratio, then that means that they're spending a large chunk of their monthly income on their mortgage payments. And if either interest rates go up, which could increase the amount that that borrower has to pay each month, or their income goes down if they lose their job, then obviously that represents risk from the bank's point of view and could lead to a loss. And this chart is very similar to the chart we just looked at for loan to value ratios. The scale on the left hand side goes from 0 to 60%, And across the bottom, we've got the debt service to income percentages, ranging from 0 to 10% on the left-hand side to 80% plus on the far right-hand side. And what this chart shows is that in the most recent quarter, ending September 2023, 47% of all of the mortgages issued in Russia had a debt service to income ratio above 80%. So that means that those borrowers are paying more than 80% of their income in mortgage payments. And obviously that represents high risk lending because it only leaves 20% left for every other part of expenditure, including food, heating, entertainment, you name it. And once again, this shows the high risk nature of the mortgage portfolio in Russia. And in terms of the Bank of Russia's assessment of the current market, in the Financial Stability Review, it stated that in the second and third quarters of 2023, mortgage lending growth exceeded 32% year on year and had risen to 34% year on year by the 1st of November. And the key driver of growth was the extensive subsidised mortgage programmes, which accounted for 63% of all issued mortgages in the third quarter of 2023. The Bank of Russia went on to say that accelerated growth of mortgage lending has been largely driven by looser lending standards. Over the last 2 years, the share of loans granted to borrowers whose debt service to income ratio exceeded 80% has almost doubled, reaching 47%. The share of mortgage loans with a low down payment, less than 20%, exceeded 50% of all newly issued mortgages. The long-lasting subsidised mortgage programmes have spurred a rapid growth of prices for newly constructed houses. And as a result, since 2020, the price gap between the primary and secondary housing markets has surged, and in October 2023, it reached 42%. This poses risks for borrowers and banks, and the price of apartments bought under the mortgage can be insufficient to repay loan obligations. Now, as we've discussed many times before, the data provided by Russia to the West is limited, so we can only work with the information that we have. And this chart shows the quarterly movement in the house price index in Russia dating back to the start of 2021. And what this chart shows is that over the last 3 years, there has been a significant increase in property prices in Russia. At the start of 2021, the year-on-year house price movement was running at around 10%. And in the 3 quarters prior to Russia's invasion of Ukraine, the market achieved growth of more than 17%. Now, interestingly, immediately following Russia's invasion of Ukraine, house prices rose by around 23%. However, since that time, the rate of increase has reduced. However, house prices have still been going up, and the data for the most recent quarter shows a 7% year-on-year increase. However, as we saw from the Bank of Russia's Financial Stability Report, there is a differential now in the price of new houses versus second-hand houses. And new house prices are being driven up significantly by the fact that borrowers can take on low-cost mortgages using the preferential mortgage scheme. So essentially, it's cheaper to buy a new house than it is to buy a second-hand house, because you can get a fixed-rate mortgage of 6 or 8% compared with the market mortgage rates of 15% plus. And as the Bank of Russia identified, the difference in October between new house prices and second-hand house prices was 42%, and that is absolutely massive. Now, of course, one of the problems that buyers of new houses have is that as soon as you buy a house, it's no longer a new house. It becomes a second-hand house when you want to sell it. And if you've got a 42% differential between the price of new property and second-hand property, you go into negative equity immediately. This is a little bit like how the car market used to operate. As soon as you drove a new car off the forecourt, it would reduce in value significantly, and you would be basically sitting on a loss. But in terms of the differential between a new car and a second-hand car, we are talking maybe 10 or 15%. The current difference between a new property and a second-hand property in Russia of 42% means that the vast majority of people who've bought new property in Russia over the last couple of years are now sitting on potential huge losses. And as we saw from the data, the vast majority of these buyers have been taking on mortgages of more than 80% loan to value. And if the value of that property is dropping by 42% on day one because it's going from being a new house to a second-hand house, then that means that there are a lot of mortgages in Russia that are currently underwater. They've got negative equity. And as we also saw from the data, the debt service to income ratio for those borrowers is also very high. So they've committed a large percentage of their monthly salary to servicing these loans, and all of this is now starting to look like a property bubble. This chart shows the movement in the official rate of interest in Russia over the last 12 months. And what this shows is that over the last few months, the rate of interest has increased significantly. This time last year, the official rate of interest was 7.75% in Russia, and it remained at that level until July, when it was increased to 8.5%. There was then a second increase to 12%, followed by a further increase to 13%, and then most recently in October we saw another rate increase to the current level of 15%. And the reason that this is important is that the official rate of interest has a direct link to mortgage rates. 63% of all mortgages issued in the third quarter of 2023 were under the subsidised programmes. However, that means that 37% of mortgages were not under the subsidised programmes, so 1/3 of the market. And the rapid increase in interest rates is going to hurt all of the borrowers who are not benefiting from the subsidised schemes. And the fact that interest rates have now almost doubled means that the cost of standard mortgages will also have doubled and are now sitting above 15%. And as we saw from the data, a lot of borrowers have taken on high loan-to-value ratios above 80%. And almost 50% of all the loans taken out have a debt service to income ratio of over 80%. So a doubling of interest rates is going to cause a world of pain for a lot of those borrowers. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's happening in the housing market is really fascinating. And the housing market is something that we're quite familiar with from all of the discussions that we've been having on what's happening in China. As a result of the overheating in the Chinese property sector, the Chinese economy is now in the doldrums, and this becomes a very difficult problem to fix, because if your economy has been growing partially due to what's going on in the housing market, if you've got lots of companies that are involved in building new properties and selling them to consumers, and prices keep going up and everybody thinks that this can never end, then unfortunately when that bubble bursts, it's very difficult to be able to rebuild it, because once consumer confidence falls in property, it takes a long time for it to come back. And what we're seeing in Russia is potentially a similar scenario. This looks like a property bubble that's been built up over the last few years. In order to increase the appetite for housing, the Russian authorities have been offering preferential loan rates. So you can take on a mortgage that's basically half the price of the standard mortgages. So that's obviously a fantastic deal. But the majority of those mortgages relate directly to new build property, so you can only buy that particular sort. And what that's meant is that there's been an explosion in the growth of new build property in Russia. And as we've seen from the data in today's video, there are now a number of factors that are putting the housing market at risk. Firstly, the borrowers who've been signing up to these new mortgages have been taking on huge amounts of debt, and the majority of the loans that have been issued have a loan-to-value ratio above 80%. And in addition to that, they also are taking on huge commitments in terms of the monthly obligations, because the debt-to-income ratio is also above 80%, which means that those individuals are paying more than 80% of their monthly income in mortgage costs. Now, all of that might be fine if property prices continue to grow by 10% forever. However, as we saw from the Bank of Russia's report, there is now a massive difference between the property prices for new properties and those for second-hand properties, a 42% differential in October. And as we discussed earlier in the video, the problem that all of these buyers have is that as soon as you buy that property, it's no longer a new property. It becomes a second-hand property immediately. And so the valuation metric for that property moves from being new build to second-hand, and therefore will fall by 42% immediately. And you don't have to be a genius to work out that if you're borrowing more than 80% of the value of the property, and the value of that property falls by 42% day one, then you're immediately in negative equity. The loan that you owe to the bank is actually higher than the value of the property. If you wanted to sell that property today, you'd have to find some other money to be able to pay off the mortgage. And obviously that is a very serious situation to be in. And one of the problems that you have when you move into negative equity is that it impacts on consumer confidence. If you own a property and it's growing in value, your net worth goes up, you feel wealthier, and therefore you're happier spending money. However, when the opposite situation kicks in and the value of your property starts going down and you feel like you're losing money, then that has a negative impact on your consumer confidence. You will start to spend less. And that's the situation that Russian consumers are finding themselves in today. And in addition to those issues, we've also had a huge increase in the official rate of interest over the last few months. It's gone from 7.75% to 15%. So any borrowers who are not taking out preferential loans are now having to pay 15% plus on their mortgages. And this will represent an absolute disaster for people who've taken on mortgages over the last few years. And as we saw from the data, the value of all mortgages taken out in the last 3 years has more than doubled. So what we have here are a set of circumstances that have built up a huge property bubble in Russia. The market has grown significantly as a result of the provision of cheap debt from the Russian authorities. But as interest rates have gone up and the value differential between new property and old property has become even more wide, there is now a serious risk that this property bubble will burst. And if it does, that will have a hugely negative impact on consumer confidence. Consumer spending is then likely to fall, and this is going to drag the economy down further. And this is coming at a time when the Russian authorities really need to boost the economy. They need consumers to keep spending to try to get GDP back up. So the overall summary of today's video is that over the last few years, we've seen an enormous growth in the housing market in Russia. That's been fueled by cheap and easily available debt. However, it looks like the Russian authorities are now reconsidering their position, and we could see a major crash in the housing market in Russia at some point over the next 6 to 12 months. So hopefully you've enjoyed today's episode, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.